Hey guys, AKIL'S here. Welcome back to the Trading Coach Podcast. In today's episode, we're going to talk about how to take a small business approach to increasing your trading ROI, return on investment. Now, before we get too stuck in, this is a video episode, so jump over to Spotify or hop over to YouTube if you want to see the video version of this. If not, you can enjoy this on your favorite podcasting app. The topic for today's episode comes from a conversation I had with one of the traders over on the Tier 1 trading platform, and I'll read you the initial question that they asked. They said, "Hey Akil, I'm doing some math for my approach. I started trading live not too long ago, and until now it's going okay compared to my backtesting data for the bat pattern on the 1 hour time frame. But I started some calculations, and with my account, which now is not too big, only $2,000 US, and if I'm taking trades 1% of my risk, and on average I'm getting 1 to 2 trades per month on one time frame, I'm coming to the results that on 12 trades per year on one pair, on a 60% win rate on average, I can only make about $40 to $60 a year. Now, if I multiply that with 8 pairs, that puts me around $300 to $400 per year, which is a really small amount of return on investment, a really small amount of profit, but also return on investment. And my target is to replace my current income, which is around $3,000 monthly. With this clue, it is really hard to achieve that even with compounding." Now, before we get too stuck into the questions, real quick for you guys that are unfamiliar with the term compounding. Compounding is a very important term when it comes to trading, a very important term when it comes to investment and personal finance as well. And that's the real secret to success, is the ability to compound your profits, right? And what it means is essentially this. Let's just say you started investing with $2,000 and you made a 10% return. Well, in that first year, right, making a 10% return off of $2,000 would be $200. Woo, right? Doesn't seem like anything special. But assuming you're not taking that money out and doing weird stuff with it, the next year you're now starting your account at $2,200. So when you make that same 10%, it's going to be a little bit more because it's the same percentage return on investment, but off of a higher starting capital. And you can see that as that starting capital continues to increase, compound, you can essentially do the same thing as far as your return on investment, but make more and more and more. Like, think about any retirement accounts that you have, and your first year when you only had a little bit of money in it, how much it actually made, and then fast forward 10 years later, it's now making a similar return on investment, but the profits are actually a lot more because the capital that is involved is a lot more. So that is compounding. And typically that's what we tell newer traders, especially ones starting with small accounts, where it's like, hey, don't worry about the monetary figure. Don't worry if it's $5, if it's $50, if it's $500. That doesn't matter. What's most important is the return on investment, that percentage. Because if you have that percentage and you can consistently do that percentage, then the question is, well, how can I just grow my account as much as possible? And again, you can compound to do that. You can get another job. You can, do a better job of your personal finance, create some extra income, and then use that to put it into your trading account. It's very easy to grow kind of the trading capital. And when you can combine all those things together, you can start compounding at an exponential rate and make more and more money. So don't think about the money. That's a big problem that too many traders get into. They're like, oh, I started with $1,000 and I made $500, and that stinks because $500 is nothing. When in reality, it's like, you just made a 50% return. Like, think about what you would do if you had a $500,000 account. That'd be crazy. So let's dig into kind of the different parts of the questions. And I want to start with things that I liked and then things that I didn't like. I don't want to call them problems, but some things that I liked was that, one, this trader is starting off by risking a very small amount, right? So if you paid attention to the email or the message, the trader is only risking 1% per trade. Now, an easy way to increase your profit is to increase that percentage. That was one of the tactics that we spoke about, where it's like, hey, because you're trading such a low frequency, because you're only trading one pair, you can easily risk a little bit more, whether it's 2%, whether it's 3%, and not really have to worry about kind of overexposure to the market because you're just not trading that much. And here's what I mean, right? If the trader is taking, what was it, 1 to 2 trades per month, then their overall risk at any given time is probably just that 1% that they're risking on that trade. Maybe they get both of their trades at the same time, and oh my gosh, now it's, it's 2% or something like that. But you see it's not a lot. You take that in comparison to someone who is trading or maybe taking 50 trades a month, right? Well, there may be a time where they're involved in maybe 5, 10 trades at the same time. If you're risking 2% on all 10 of those trades, now you've got 20% at risk. And that's a lot to have at risk at any given time. So because the trader is trading so infrequent, right, they can actually afford, if their risk appetite is up to it, to risk a little bit more. And that's a way of increasing your profits, because the more you risk, the more rewards you'll have with that risk. But with that being said, newer traders, I like that you start small, because what do we always say here on the Trading Coach podcast, right? When you're in the newer phase of trading, you are most likely to make the most mistakes in your trading career. So while you're in that kind of period where you're most vulnerable to making errors and making mistakes, you want to have as little at risk as possible. That way, if/when you do make those mistakes, you're not blowing your account and costing you a lot of money. As you mature and get older and you get better and your mistakes get less, and these are things that you can track, right? You can quantify your mistakes. That's something that turned my trading around. Now maybe you can afford to risk a little more, because you know you're not going to do as much dumb stuff, and all of your losses are going to actually be natural losses in the market instead of those self-inflicting wounds that come with come from undisciplined traders. Something else that I liked about this is that the trader is starting simple, right? He's starting by trading a single pattern, I believe, on a single pair on a single time frame. And that's something that my mentor always told me. He said, Akil, just start by being good, trading one thing on one time frame, and on I'm forgetting something now, brain fart. One thing, one time frame, one pair, one pair, one strategy, one time frame. There we go. Brain farts all over the place. It's been a long day. But he said that to me because if you can't be good at that, the simple, how are you going to be good at anything else? And I was a younger trader who wanted to do everything. I was like, yeah, I'm going to trade 18 strategies on 26 pairs. And he's like, well, think about, do you have the mind space to deal with that? Like, can you actually do that? And the answer is no. So he said, how about you get good at one thing, and then once you're good at one thing, you can grow from there. And that's one of the key approaches that I've taken in my trading, and it's helped me really progress. It's slower. It's a slower progression, but it's a much safer one and a much more profitable one. Now, some things that I don't like. The trader has a very low frequency. 1 to 2 trades per month, especially on an hourly time frame. That's not a lot, right? Take it from someone who comes in. I don't day trade anymore, but I still look at the charts on a regular basis, right? It's, you hate to say it, but like, traders want to trade, especially as a newer trader, right? As newer traders, you have this, you want to trade, you want the action. No one likes coming into the markets and being like, nothing's there, let me go do something with my life. Now, I don't mind that right now because I've been trading for a long time and I have all these other fun things that I can do during my free time. So sometimes I get excited where it's like, nothing's there. Let me go out and hit some golf balls or something like that. Rory, right? Shout out to Rory, by the way. Way to get that monkey off your back, although you almost blew it. Golf is very similar to trading, not to get too much, distracted. But I don't know if you guys watched the Masters. So Rory McIlroy won the Masters. It's a career Grand Slam, which means he's won all the best events. However, his history at the Masters is choking. And he pretty much did the same thing, right? He came into the weekend, I think, up by 2. And he had this weird final round where he choked right away, blew his lead, right? Bad trades. But then he hit a few of the most amazing shots in golf history. Good trades, right? And I remember when I was really, really serious about playing golf, it was the most frustrating things because you have these periods of really, really, really good things, and then you blow them with the dumb things. And trading is the same way, or at least my trading was the same way, where when I was a newer trader, I'd have these amazing hot streaks, and I'd do so good, and I'd be like, I made it, I got it, I'm here. And then I would do dumb stuff and blow it all. So Rory reminded me of that, having the dumbest shots in the world, directly followed up by some of the greatest shots in the world. But he won, so hats off to Rory. But yeah, having a low frequency is hard because you have this desire to trade, and when you have this desire to trade and there's nothing there, the brain does this weird thing where it starts creating trades. Then all of a sudden, your eyes are creating things that aren't really there. You're seeing ideas from other traders. You're like, I can trade that too. You're sitting back like, no one would know. And you put yourself in a situation where you're more likely to make mistakes simply due to boredom. Not only that, sometimes you forget your routine. You're so used to coming in and seeing nothing that you're like, I'll wake up late today, and then boom, you missed the one trading opportunity that you could have had. I remember speaking to a trader. We had a live event once. One of the most brilliant traders I've ever worked with. He created this strategy, and the whole. We did this event where we brought a coder in. The whole thing is we were going to take this strategy and then automate it, and then give it to our mastermind group as an automated strategy where we coded it and just gave you like a couple arrows or signals that said buy here, sell here. So the trader's going over this strategy, and we're starting with price action. He's going to indicators, and he's giving all these if-then things. We're writing it out in code. And what's funny is that the traders, the strategy was so complex. It had a very, very high win rate. It was like 90% correct, right? But it was so complex that it only offered like 1 or 2 opportunities a year, right? And he was like, yeah, right? It's awesome. We're like, no, right? I'm like, think about this from a realistic perspective. Like if you get 1 or 2 trading opportunities a year, the odds of you missing that trading opportunity, being sick during that trading opportunity, being bored and forgetting to check your charts during that trading opportunity, right? The odds, and odds is maybe not the right word. I can't think of it right now, but pretty much what I'm saying is this. If you miss that one trading opportunity, you're screwed. I should have just said that in the beginning. You're screwed if you miss that one opportunity. Vice versa, if you have someone that takes 1,000 opportunities, and when you're screwed, it messes up your equity curve. It messes up your entire return on investment for your year. Your entire business is dead. Imagine like creating a business and your whole business is around selling one thing. If that one thing doesn't sell, you're screwed. On the other hand, right, if you're someone that takes 1,000 trades a year, just throwing out a random number, if you miss one because you're sick or you forget, whatever like that, it's really not that big of a deal. So, right, when you have more frequency, you can afford to make more errors because you have more chances to make up for those errors. When you have less frequency, you got to be pretty darn accurate with the chances that you get because they don't come too often. So I do think frequency is an issue in this case. The other thing is that the return on investment, the total is very small. If I remember the math I did correctly, off the first number that they gave me, where it's like $2,000 account, I think they made like $40 to $60 profit. That's only about like a 3% return per year, right? Our goal should be to average 3% a month. So in the less disrespectful way possible, like it ain't worth my time to make 3% a year. What is 3% a year doing for me, right? It's doing absolutely nothing. And I always like to think of things in the term of opportunity cost, where it's like, well, Akil, 3% is something is better than nothing. Yes, but think about the time and the energy I'm investing to make that 3%, right? You may love your job. If you got paid, $1,000 a day, you would go to your job every day and it's worth whatever your job has you doing. If you had that same job and they paid you $1 a day, would you go? Probably not, but it's still money, but it's not enough money versus our time. So I look at this in the financial markets and it's like, hey, what are the alternatives, investment alternatives, where I can also make 3%? I think it was a year. I think he's talking about a year. I'm not sure if it's a month, but we'll go for a year. 3% a year is really, really small. So maybe he is talking about a month. Let me just go back and look real quick. Okay, I just reread it. He actually is talking about 3% a month, which changes things, right? So what I was going to say is 3% a month or a year isn't worth it, right? You might as well put money in the S&P, be a passive investor, and you'll make much more than that, aside from these weird Trump tariff times. But in normal circumstances, yes. But I just reread it, and the trader is talking about 1 to 2 trades per month. So I'm assuming the ROI is based off that monthly, which is 3% a month. Which I'll tell you what, that changes things, right? 3% a month isn't bad at all. If you can average 3% a month, I'll let you guys do the maths on that. But you're going to be in a good position as a trader. I remember speaking to, I think it was Mike Bellafiore who told me this, where I was asking him early on in my career, I'm like, hey, what does a good trader make? And he said, and I believe this was him, it might have been someone else. I spoke to a lot of people, but he said, if you can average 2% a month, you're considered a good trader, right? If you can average 5% a month or above, you're considered a great trader. So I've always put that at least that minimum goal in my head has been 3%. It's between 3 and 2 and 5. I don't want to do the decimal, whatever like that. So if you can average 3% a month, that's actually pretty good. You're looking at, what is that, 26% per year? No, 36% per year, which is good. Now we can take it back to the compounding conversation that we had before. If you can make 36% a year, it doesn't really seem like much from a monetary perspective right away. But as that account grows and grows and grows, that 36% becomes more and more and more. And what I always advise you guys to do if you want to take a look at the big picture is create a spreadsheet and have it go over 10 years, right? And what you'll see is that in those first 5 years, you're probably going to be pretty, underwhelmed with your results. But after year 5, that's when compounding kind of boom really kicks in, and look at the exponential growth that happens after that and use that as kind of a guide where it's like, I need to be patient and just wait this thing out. Or like I said before, you can start adding extra income and just increase that curve growth. So what are some solutions to this problem? Our trader already named a few. And the main solution is increasing the frequency. So increasing the amount that you trade. And there are multiple ways to do this. We'll focus on 3. One, how do we increase frequency? Well, we can drop to a lower time frame, right? If you're only getting 1 to 2 trading opportunities a month on the hourly, this is with the kind of the one pair. Obviously, if you multiply this and grow this by more pairs, you get more. But if you're only getting 1 to 2 trading opportunities a month on the hourly, the lower the time frame you go is going to open up more opportunities. So maybe you go down to a 15-minute chart and maybe you double that. Maybe you go down to a 5-minute chart, maybe you triple that, right? The lower you go on your time frame, the more candles there are, the more opportunities there are. There's more junk and more noise as well. So the win percentage may drop. I've always noticed that in my trading career, that the lower the time frame I went, the lower my win percentage was. But you will increase that frequency, giving you the opportunity to trade more. If your strategy has an edge, when you trade more, you'll win more. When you win more, you'll make more. And boom, we're heading in the right direction when it comes to this problem. Number 2, right, because we can't all drop to a different time frame, right? This trader may have set up the hourly chart as their trading time frame because that's what fits best around their lifestyle. They don't have time to actively day trade. The hourly is maybe the sweet spot where they can take a break from work, come back in, look at the chart, place some orders, bada boom, bada bing, and be out the way. So not, going to a lower time frame, being a day trader is not something that everyone wants to do or everyone can do. So the next solution, this is what this trader already mentioned, is increase the amount of pairs that you trade. Instead of trading 1, trade 4, trade 6, trade 8. I remember my business partner, my good buddy Darren, right? So he invented the cipher pattern. So of course, selfishly, when he traded, he created a portfolio of only trading the cipher pattern. And he was in the same situation. I think he traded on hourly and 4-hour, and he wasn't getting that many opportunities per month. So what he did was he just stretched out his portfolio. He's like, hey, I have like a 20 pair portfolio. I'm still looking for one thing. I'm still looking on one time frame. I'm just trading it across a massive amount of pairs. And that's how he upped this frequency, because within those 20 pairs, he probably got a trading opportunity daily, I would guess. Now, piggybacking off that idea, another solution is increasing the amount of strategies you trade, right? So you've got the bat pattern, which are traders trading, and it only gives you a certain amount of opportunities per month, right? Maybe you don't want to go down to a lower time frame and be a day trader. Maybe you don't want to add more pairs because you like the pair that you're trading, right? Add more strategies, right? Something that goes hand in hand with patterns are other patterns, right? So if you want to stick to the pattern theme, right? Instead of just trading bats, you can trade Gartleys, you can trade ciphers, you can trade butterflies, you can trade crabs, sharks, 5-0s, they go on and on and on, right? Increase the amount of strategies that you trade. That way, again, it just gives you more opportunities on that chart. My natural progression as a trader after the years of doing all the dumb stuff and finally getting solidified and finding something that kept me disciplined was to trade the Gartley pattern. So I traded the Gartley, I learned the Gartley pattern, I traded the Gartley pattern, I became successful with the Gartley pattern, and I was in a very similar situation as this trader. So what did I do after the Gartley pattern? I added the bat pattern, I added the cipher pattern, I added the butterfly for a little bit and then took that away, but that's a story for another day. But I wanted to keep to the pattern theme because I needed that at that time in my trading. And that's how I increased my frequency. Eventually, I started adding my counter trend price action trading, and I eventually added my trend continuation trading as well. So I still trade a very small portfolio. I trade a 9-pair portfolio, but I trade a massive amount on those 9 pairs, and that's what I use to increase my frequency in the market. Now, the last thing this trader can do is some type of combination of all of them. It could be a combination of number 1 and number 2, number 2 and number 3, number 1, 2, and 3, right? There's kind of an endless way of doing this. This trader can be, hey, I'm going to be a swing trader and a day trader at the same time. I did this in my career where I day traded for 3 hours a day each morning, and then all my swing trading stuff was running run in the background, meaning I'd place orders and take trades when they came, and that was a good little mix. You can add more pairs and more strategies. Now, again, there's a point where you have to pay attention to your risk. You got to do this smart risk rise. You don't want to be trading 20 pairs and 20 different strategies, and now you're getting 20 trades a day, because again, you put yourself in a situation where you hit a cold streak, or you can easily hit margin call or something like that. But there is a smart way to do it, and I'm hopefully speaking to this trader, obviously, and you guys out there, you're going to do that in the most educated way, not like some of the idiots we see out on the internet. So I guess you could say the key is this, right? The key is thinking about trading as being no different than any other business and how you would grow a business. If you are a business that sells hamburgers, that is your specialty, AKIL'S burgers, right? You're a new startup, you're probably going to start with one building and they're going to sell one thing. I'm going to have one restaurant. It's going to sell burgers. That's all I'm going to sell because I'm good at it, and boom. And you get a certain amount of people that come in and they only buy the burgers, right? As your business grows and expands, if you want more, you have a few different options. Well, okay, I can either add locations. So instead of one AKIL'S burger shop, now I'm going to spread out and make 2, 3, 4, 5, right? And get more customers that way. Or I'm going to get customers in the door by giving them more options, right? So instead of just burgers, I'm now going to sell chicken nuggets. I'm now going to sell salads. I'm going to sell, drinks, milkshakes, whatever I'm adding, because now I'm attracting a different type of demo. I'm also, people are probably buying a burger and a milkshake at the same time, right? So I'm doubling my income, not doubling my income, I'm adding to my income that way. Or again, you can combine all of them. You can have a store, you can add more options, and then add more stores, right? So you can grow your trading in all different types of ways. And it's what's amazing about trading is that this is your business, so you can do so in the way that best fits your goals and best fits wherever you're at in your life. So I hope you guys enjoyed the episode. If you have any advice for this trader that I may have missed, because I do these live and I don't really think about them before I record them, leave it in the comment section below. And also remember, I have that 60,000 subscriber goal over on YouTube. So do me a favor, subscribe if you're not subscribed already. And if you know someone that likes trading content, forward them to the page. And if they like what they see, encourage them to subscribe as well. There's no magic reason why I like it. I just like giving myself goals to keep myself motivated, and I'm close to 60,000, so that might as well be the goal. All right, until next time, plan your trades, what you plan. Take care.